We are standing by for breaking news on interest rates.
Good afternoon, everyone. I'm Peter Overton, coming to you with breaking news. In a matter of moments, the Reserve Bank will deliver its July interest rates decision. The board expected to hand down its first back-to-back rate cut in more than 5 years.
People are hurting with interest rates and the cost of living is so high we must drop rates. That's how people think.
The general consensus among economists and market traders is that the RBA will cut.
We're certainly being told over the last few weeks to expect an interest rate cut, that is one rate cut today, but that was the surprise last time from Michelle Bullock that the double rate cut is being discussed. We'll absolutely be asking her this afternoon at the press conference about whether or not that is still the case. But this interest
on hold,
rate...
Chris, on
hold.
hold.
That is a big surprise.
On hold.
Okay.
Stop that.
Is this also an indictment on the Labor government and its handling, its economic management, do you think?
Oh, beyond a shadow of a doubt. I mean, the Treasurer has come out and pointed out that other countries are cutting interest rate while Australia isn't. But other countries haven't got a productivity problem, caused by, huge government spending, more taxes and more regulation than the eye can see. Of course. The RBA's job is not there to compensate for bad government economic policy. Its job is price stability and full employment. If the Treasurer wants interest rates and a healthy economy, he should actually do something about it and pursue a productivity agenda.
Well, I think that it's that a lot of these economists were hoping rates would come down, and mainly because of what they see in the immediate data, not leading but lagging data, debt, household, cost of living. And I look at that in an adverse way, is that things, not one item that anyone can think of has gone down in 6 months. Not one item has gone down in 3 months, not one item has gone down in a year. So I can't think of anything. Nothing in food. The women are great barometers of shopping than what we are, but certainly food, any item, petrol, fuel is up and down. That's moving because of fuel and oil demands. But generally speaking, over a year, certainly power hasn't gone down. Water rates haven't gone down. Municipality rates haven't gone down. Food and essential items. So nothing's dropped at all. I can't think of anything that has dropped. So the economists and the data read people are hurting with interest rates and the cost of living is so high we must drop rates. That's how people think. We must drop rates to stop the hemorrhaging and we must assist. Okay, so that's what people think when they're inside this bubble. You remove yourself and take the high ground, look at it from the moon and say, okay, things haven't gone down, but is it a time to drop rates? And what reactions do we get in the markets when we drop rates, spending increases on essential, non-essential items, and prices tend to blow out, and so property prices will increase, and they probably will to a degree, because if you've got a first home buyer with $200,000 and they go to the bank for $500,000 loan at 25 basis points, means that they'll get another $26,000 from the bank, because it's not LVR centric, it's more focused now on interest coverage ratios, ICRs they call them, the serviceability ratios. So they're very conscious of that. What they're really petrified about is, and when I say petrified, I'll give you some idea. The way I look at it is that they cast their mind back to sort of 1989 to 1992, and they thought they had a grip on inflation. And they started to, both here in the States, started to ease back on interest rates. And then inflation just exploded like the bull run. I don't know if you've ever seen the bull run in Spain, and it just opened up, and inflation blew out of control, and interest rates went to 18, 19 to 20% on credit card. So that's what they are absolutely petrified about. And to give you some idea of the impact of that, and some people say, oh, well, that was 1990, Paul. I mean, you bring up yesterday's race guide. This is a key thing. We have 18 times the amount of debt. If interest rates blew out and got out of control at anywhere 75% of what the early 90s was about, the 16, 17, 18%, at 75% of that, in this environment, I used to play a lot of poker at uni, and there was times when I never lost my car, but there were people that would run out of money and they put their keys of the car on a bet. They weren't expensive cars, 500 to 1,000. I saw a lot of guys lose their cars and they had to leave their keys. It was pretty irresponsible back then, but that used to go on when we used to play pretty seriously. Leaving the key theme, you could see that people would have to leave the keys of their home. That's how serious it'll get. So if that blows out, 75% of what it was now with 18 times the amount of debt, you're talking about interest rates would blow out where it would put the value of the home, assuming the ones with mortgages, the ones without debt, I'm talking about the ones with mortgages, you start to see the serviceability cost and the banks call in those and they're 30% under the value of the home. That's the problem. Now that is frightening. So if a guy, you've got negative equity of 30%, the banks just call those in. That's how serious that is. The United States is obviously on a different scale, of course, because there's with Canada, the United States, and South America, it's not 350. If you include South America and Canada, you're talking about 515 million people. Well, they're in the same boat on a bigger scale than what we are. We're at 25.9 million and 15.9 tax. So when you put that in perspective and you put some horror show in front of a person, they think, okay, I understand it now, Paul, I won't whinge about a 25 basis point decrease. That's what the party and that's what the panel, 6 out of the 9 voted to hold rates and 3 to cut. And that's why you have a panel at the Reserve Bank. And so I think it was the right decision. They're trying to squeeze as much inflation out of the system and they want it consistent, not just a low quarter or a low month. They want to make sure that it's like cancer. Let's make sure we get it all. That's what a surgeon will do. That's what the politicians are doing. We've got to get it all before we even start to think about reducing rates. So I think this year you'll probably see, I think inflation slow. It's slow. You might see 0.5%, 0.75 at best decrease in rates. And I think that'll come in October, September, October. But I wouldn't see anything more than that of interest rates coming down certainly 1% over the next 3 years. I think what we have now is give or take, get used to it.
Stop that.
Not only corporations are concerned, but countries are concerned. Large corporates, small to medium-sized businesses, everyone's impacted. And that hasn't helped. I think without tariffs, they would have still held rates. The tariff issue hasn't helped, and that will now give rise to delayed response until we understand what impact that has. Another thing to add to the list. You know, the tariffs, it's an impost, and it's a cost to business. How much, you know, if you start talking about commodities and minerals and things, as far as copper as such, and I think in mining, that's a concern. But that we need to digest that and just to work through what impact that has. But that certainly will not, that hasn't helped interest rates, pulling back on or decreasing interest rates.
Stop that.
Well, you can't. I mean, so, you know, that's why, I mean, you know, I like to think of myself as contributing to the environment as much as anyone else. But the whole idea of global warming and you know, reducing emissions and so forth is fanciful. It's taken 300 years to destroy the atmosphere, and we're not going to fix it in 20 or 10. You know, or affecting the atmosphere in the last 300 years. It's going to take, you know, 20 to 30 years to affect that. So power costs will continue to increase. I can't see how that how there's going to be any ease on power costs, and there's more of a demand on power costs too. So yeah, it's interesting when I was reading the notes from the AGM from Visy, and I was fascinated about 6 years ago, and I've been to a lot of the Pratt Foundations and so forth. It was interesting to read about Visy's position and why they'd moved. That 70% of their revenue at that time was coming from the United States. And I got to meet Dickie Pratt many years ago, and I met Anthony before at lunches, but Visy, for example, is 70% US, 30% revenue from here, and 49% of New York's cleanup and recycling in New York is Visy. And when we was approached about, well, why have you now moved? He said, look, the labour cost, the cost to do business, and in particular power cost, was we just had to move offshore. So one of the key things was labour and power, and I found that fascinating. And I thought, wow, but when you look at the drive of energy to there, if you go through a Visy, and I've got property areas where Visy are, they're 24/7. They're just constantly running all the time. And it's the same you're going to see with when we go to data and AI. AI, don't get me started there. AI with energy costs, people don't realise the power draw from the grid. They're not going to do that through windmills and solar. And so AI, people don't have any idea. If moving to AI and the data, I mean, we're building a data centre at the moment. Now the power requirement to run that is about 12 times of the normal operation of a automated logistics business. Just the data, the power supply. And so people don't realise that. So AI is going to have an immense amount, well it has, of energy and power requirements. So coal's here to stay for a while to drive AI. It is not going to come from windmills and solar panels. It's just not going to be enough. Isn't it interesting that we want that? We want the environment contained and a better way to live for our kids in future. Now this demand of AI, people can't get enough of it, can't get enough of AI. And at the same time, does anyone realise that they're going to have to go back to the traditional source of energy to drive that AI? I don't think a lot of people think about that, but that's a fact.